So a warm welcome everyone, and thank you for joining this Hardman Co Investor Forum. My name is Keith Hiscock and I'm the Chief Executive of Hardman Co. These forums give investors the chance to hear a company's investment case and to question the management. And today we've got 4 companies presenting. Our first presentation comes from Filta PLC. Filta provides cooking oil filtration, fire and drain management services to commercial kitchens across North America, the UK and Europe. And it combines a capital-light franchise model with some company-owned operations in the UK. COVID-19 obviously been an important part of the last year for everybody, but particularly for Filta, and it's both been a headwind and an opportunity. We're pleased today to have both the Chief Executive, Jason Sayers, and the CFO, Brian Hogan. And gentlemen, let me hand over to you, Jason.
Thanks, Keith. Hi, everybody. So this presentation's about introducing our business and the business model to you guys. It's not sort of our annual report. So we service commercial kitchens. The best thing about our business, we have regular repeat revenues to these customers. The downside, industry was hit pretty hard by COVID-19. At its low point, our UK and German markets were closed with a 90% reduction in revenue. However, what was in our control is how we reacted to it. We were still profitable, £1 million at the EBITDA, including 300 grams worth of bad debt provision for COVID, cash positive, showing really a robust model and robust team. There's actually 2 of us today, myself, CEO, and Brian Hogan, CFO. We're both based in Orlando, Florida. That's where we're here from. I thought it was best to bring Brian on to talk about some of the financial side. Let me get to the company overview. So our company's Filta Environmental Kitchen Solutions. I started the business in the UK in the late 90s and came up with the idea for Filta Fry, cooking oil filtration and fryer management service. We expanded this through franchising in the UK and through selling master licenses in other countries. But the obvious market for our service was the States. So in 2003, I came out here with my business partner to grow the business here. So we now operate in the UK, North America, and Germany. We have 2 primary businesses, Filta Fry, that's the cooking oil filtration and fryer management service, where we take care of customers' fryers and cooking oil. And we have a grease and drain management business in the UK. We service well over 7,000 commercial kitchens every week, and we deliver the fryer management service through a network of 191 franchise owners who pay us monthly royalties and fees. We deliver other kitchen services through 55 company-operated vans in the UK. Both provide us with very fixed repeat revenues for our business. The historical and future growth comes in a small part from new franchise sales, most importantly, our existing franchise owners expanding and our operational business expansion. We're well positioned now to take advantage of the sector recovery that we're seeing. So you see here, let me explain what we actually do. It's a graphic of a commercial kitchen. Everything we do is focused on high margin recurring revenue from that customer base. So Filta Fry, cooking oil filtration and fryer management service. So you see the fryers there. Problems in kitchens include high oil usage, poor quality food, hot oil accidents, slips, falls and burns, insurance claims. We solve all these issues. So we come in, so we pull up a van, wheel our machine out next to the fryer, suck the oil out the fryers, clean the fryers, pump the oil back in so they can reuse the oil again. And at the end of the life, we take the oil away and we sell it to make biodiesel. Usually we do this once, twice, 3 times a week. And the cost for the customer is normally recouped in oil savings, particularly now as the price of cooking oil has doubled in the US in the last year. Competition is principally in-house employees doing it themselves. And we have 468 trucks on the road performing this service in the US. Filta Fog's our next service, another one of our core services, fats, oil and grease management. So sinks, washing machines have a lot of waste oil going down the sewers. This leads to blocked drains for the kitchen and fatbergs in the main sewers, blocking the flow permanently. We install what's called GRUs, grease recovery units, under sinks that separate oil and water before it travels down the drains. We have the best performing equipment on the market. We sell these units in, we install them, we sign contracts to clean and maintain those units every month or quarter, providing us with ongoing, again, service revenue. We basically keep customers compliant with the ever increasing water authority enforcement in the UK. Filter seal is our next service. So those same customers have fridges. Those fridges have seals. Those seals wear out and need to be replaced every year or so. Typically, the place phones their refrigeration company. The refrigeration company comes in, measures the seal, goes away, orders it, comes back and fits it. Time consuming and expensive. In 2010, we bought the patent to some equipment that allows us to turn up on site, measure the seal, go in the van, manufacture the seal and fit it all in one visit. It's great service, so it's quicker and it saves the customers money. Again, it's all aimed to keep the customer compliant with health and safety regulations in the UK. Two other services, Filter Pump, the same customer base have pump stations for pumping waste off site. We install and we service these, again, keeping customers compliant. And Filter Vent, we introduced an automated vent cleaning system last year. Very early days for this, but we hope to roll it out in the coming years through our existing customer base. Again, keeping customers compliant with fire regulations. So let's have a quick look at our revenue model. How do these fit into our revenue model? We have 4 segments of revenue. We've got franchise development, fire management, equipment sales, and site services. Franchise development is the one-off fee we get from selling a franchise, primarily in North America. Then we have fire management. This is the repeat revenues we get from franchisees who perform the fire management service. So we provide a lot of support to our franchisees. Sales, so we have a telesales team getting them work, tech recruitment, accounting, marketing, technology. So we generate fees for that in several ways. We have fixed royalty per machine. So we have a machine, it's our machine that they wheel into the restaurant. That machine, they pay us a royalty, $750 a month, every month. They have 2 machines, they're $1,500 a month. We take it by direct debit every single month out of their account. We then make margins on supplies and waste oil. So the blue piece on the left is the franchise model, primarily in the US. On the right, the green is the company operated model in the UK. So a bit like franchise development, equipment sales is one-off revenue from selling in the GRUs, the vent systems and pump stations. That's one-off revenue. Then our whole aim is to generate recurring revenue, which is site services. That's GRU servicing, seal replacement, vent servicing, pump servicing, and the Filter Shield COVID-19 spray service we introduced last year. All of that is the recurring revenue part of our business, and to grow it, our aim is to grow it year on year. Over 85% of our revenue is deemed recurring revenue each year. So let's have a look at where we are in the geographic markets. North America, we're based in Orlando, Florida. That's where we are now. We only have 14 staff members in the US supporting 146 franchisees who have 422 machines in the field. That's vans. Our network revenue, that's our franchisees revenue, in 2019 was $52 million. In Q1 last year, that grew 20% year on year before COVID hit. So our run rate was around $60 million a year, growing nicely. But then COVID hit. In Q2, there were fairly strong lockdowns in the US before it opened up in Q3, Q4 to a point where we were back to almost 70% of prior year revenue by the end of the year. Really depend on where you were in the States of how it's been opening up here. We supported our franchisees by lowering those fixed fees based on their revenue reduction. And we recently invested further in our sales team ready for the recovery. And you'll see some of the results of that in a minute. In the UK, we're based in Rugby. We have 36 franchise and 55 company operated vans there. In Q1 last year, we'd improved margins following the acquisition of What Bio, feeling pretty pleased with ourselves, then COVID hit. Q2, strong lockdowns on and off ever since. We're just coming out of the last one, as you know there. But again, we invested in our sales team and focused on our relationships with key customers. Mainland Europe, we're focused in Germany, significant potential in Europe for us, but severe lockdowns in 2020, which continues now in Europe. So that stopped us in our tracks. We only have 3 staff members in Europe, so reduced overhead until the macro picture improves there. But we're focusing all our efforts and resource on the real growth opportunity now in the US and the UK. So let's have a quick look at North America post-COVID. So the economy only shrunk by about 3.5% last year in the US. The government, whether you agree with it or not, are injecting over $4 trillion into the economy here. You can feel it. It really has grown, and it really has, depending upon where you are in the States, as to what's happened. Here in Florida, we've been fully open since about September last year. No restrictions, you can go out. In different parts, California, New York, they're really starting to open up now. Vaccine programs are success. They're doing up to 4 million people a day here in the US. And everything, the sector's recovering really quickly. And really, OECD, this was put together in March, had US growth of 6.5% this year. I've seen that go up and up since then to 9%. So things really are growing well in the States. Impact for us, many sites have now reopened, now increasing their service levels as well for us. When I mentioned we put resource into our sales team, so during COVID, so since last year, last January 2020, we serviced just under 6,000 restaurants or served commercial kitchens in the US. This January just gone, we serviced 4,500 of those 6,000. We added 935 sites during COVID, so we focused our sales team on growing that, and we still have 1,500 sites still to open of the sites we serviced before. They're the bigger ones. They're the stadiums, universities. So we service over 700 stadiums and universities in the US. Some of those have over 200 fryers per site. These are major customers for us. And we're really taking advantage by focusing all our efforts on the sales in the US and riding the wave. In the UK, you're more familiar with it there. The lockdowns have been a lot more severe and affected the economy worse, with almost 10% reduction in GDP last year. Government support's been exceptional. Household saving rates doubled during that period. Vaccine program a success. We're seeing it open more quickly now in Q2. I'm sure everyone's aware when your local pubs are opening. So a very similar chart here. In Jan-Feb last year, we serviced 4,400 customers in the UK. Of those in Jan, we serviced 2,000. We've added 750 sites. So we made decisions at the beginning of lockdown. Let's focus on a couple of things. Let's focus on cash, because no one knows how long the virus is going to last, whether it was a year, 2 years, 3 years. We also said, let's focus our efforts on particular types of customers. Let's go after fast food, because we thought they would stay open during COVID, and let's go after supermarkets. Those are really the customers we've been opening in the UK and the US since then. So really, we're expecting it probably back to full servicing by Q3 as the pubs really do reopen, as some of our major customers are those pub chains. Moving on to the next slide here, our market. Currently, we service over 10,000 restaurants, 2,000 supermarkets, hospitals in the US, sports stadiums, universities. So you can see in the US, our major customers, Compass, Sodexo, Aramark, Delaware North, we have exclusive contracts with those guys. That's the stadiums and universities I was talking about. Those really still have yet to come back. We're seeing them starting to open now. In the UK, our major chains we service, we have contracts with McDonald's, Costa Coffee, KFC, Asda's, Tesco's. Our biggest customer was Mitchell & Butlers, so they're now reopening. They've been pretty much shut since lockdown. Green King as well. So you can see we service some good names. One thing that's happened during lockdown, we've got really close to our customers, helping them come out of lockdown and obviously getting close and helping them solve problems they've got. Currently, we have less than 2% of the market, so we're really aggressively looking to expand right now. The growth strategy is to maximize existing customer relationships by upselling products and services, then add complementary services and products and gain new chain customers. Again, that's US and UK. I'm going to show you quickly some revenue trends. So we were growing nicely, 2018. We had just under 50% gross margin in the business. We bought What Bio right at the end of 2018. That's the biggest player in the UK in the grease recovery market. You can see our margins shrunk. So it took us a year really to get that business right. You can see in 2020 there, our revenues dropped due to COVID, but our margins increased. So we're looking to hold that margin as we grow revenues in the coming years. Cash and liquidity, let me just hand over to Brian to give you a quick overview of that.
Thanks, Jason. As Jason alluded to at the outset, this presentation is not tremendously focused on our results for 2020, but I'll just remind everybody that we did issue results back in April, and Hardman updated a note as well to correspond with that. I think the message that we'd like to deliver here is, looking back now 12 months or so from when COVID first affected the business, if you would have told us this is what the results would be for 2020 and this is what the outlook would look like, I think we would have signed up for it with all the uncertainty back in March of 2020. The focus has been always consistently on cash and liquidity in the business. We grew cash by 45% in the midst of the downturn. That was on a losing revenue. We lost about a third of our revenue, as Jason showed in the prior slide. So the ability to grow cash, we took advantage of all of the opportunities that were out there. We operate principally in North America and the UK. Both governments offered support. We took advantage of that support where it was available. The net debt was reduced in line with the cash increase. So again, we've come out of this year in a much stronger balance sheet position, and we're well suited to grow the business, whether that be through acquisition, whether that be through taking advantage of competitors in the market who probably didn't fare as well during COVID as we did. So, and the resources that Jason spoke about that we've put into sales and some R&D as well. I think it's important to note that we are historically a strong dividend payer. We pay about a third of our earnings out, net earnings out in dividends annually. We did suspend those like a lot of companies. They remain suspended and did for 2020, but we assume that we'll be a dividend payer again in the first half of 2021. Where we sit today, cash has grown from what you see there. Net debt has reduced further. We anticipate we'll be in a net cash position by Q3, the end of Q3 of this year. So again, strong cash position, strong balance sheet position, reduced headcounts, reduced overheads, and we won't bring, there are certainly large portions of both of those that won't come back because we've learned to operate the business in a more efficient way. So coming out of bio, I think, despite, as I said, despite a decline in revenue, we saw margins increase. We saw an improvement in cash, and overall liquidity, a reduction in net debt. We're well suited to take advantage of the upturn coming in 2021.
Thanks, Brian. I'll briefly mention ESG integration for our business. Our services at their core provide environmental benefits. In fact, for many years, we've provided our customers with environmental impact reports for the last 10, 12 years. Later this year, well, we're starting it now, we're publishing a full ESG overview and reporting platform that will certainly show our business in a favourable light. So summary and outlook, the overarching message is that our industry sector is recovering quickly. We expect it to return fully by the end of this year so we can get back into full growth mode for next year, 2022. Margins have improved and we have the infrastructure now in place to grow the business quickly. The next 2 years is all about sales. The majority of our resources going into driving this. We'll continue to seek acquisitions, but for me, macro is more important than micro. The last year we've been fighting the whole economy with COVID. It's been tough. I think we've done a decent job. Flip side of that, the macro picture's improved significantly with all the money that's been invested in the economy. So we're looking to ride that. And we're pretty excited about the market conditions over the next few years. You can go to our website, filtaplc.com. You'll see you can subscribe to a newsletter there or ask any more questions from that. Other than that, I'm open to answering any questions you may have.
Right, so we got a number of questions, some quite specific, but I'm going to start with the ESG topic because it obviously is one of the biggest themes that investors are interested in. So presumably, how true is it that your own customers are in fact almost a sales force for your own initiatives, and are less resistant to taking services because they realise the social and environmental impact?
So, we have for years provided environmental impact reports. Not only does it show the customers CO2 savings, pesticide savings for prolonging the life of cooking oil, for example, but we give them a certificate at the end of it. Every report comes with a certificate that they actually display in their kitchen and outside for the customers. So it depends who the customer is. We have universities, love it. Stadiums, love it. Anyone in California loves it. So it depends on where you are and what customer base, but that's one of the big advantages, you're absolutely right, is the environmental side. And we're about to take that to a new level of engaging with our key account customers because what's important to the customer is important to us. So if their driver is, for example, CO2 savings, we can provide that information to them because all our waste oil goes to biodiesel and offsets diesel. So we're big net savers and we can provide that to customers. Hopefully that answers the question.
Yes, I think it does. So let's start with a question from Stuart. How many of your customers do you know have actually gone bust due to coronavirus and obviously won't therefore be available to take your services in the future?
So in the States, very, very few, because the bigger pictures, the players, the stadiums, the universities aren't going anywhere. They're just taking a long time to open. The smaller places, the restaurants, opened surprisingly quickly. 96% of our restaurant business reopened straight after the first lockdown and have remained open. They were very adaptable over here for takeouts, etc. So the States, very, very little. The UK is a different picture. The UK, we deal luckily with many major chains. That's one of the acquisitions of what Bio, we got that customer base you just saw. McDonald's didn't close any, Tesco's are growing. A lot of that customer base, the big chains are growing. The pub chains are the ones who we're looking at closely. We expect them to close some of their estates, M&B, etc., probably close 25% of their estates. From our end, we tend not to service the smaller places. We tend to be the higher volume units. So I think the answer is wait and see. It's still playing out in the UK, but our customer base really is a lot of the big chains. So we're seeing those being pretty stable throughout.
What percentage of your US customers take every one of your core services, and what are the opportunities for cross-selling products across a wider customer base? Good
question. So in the US, we're very fixed on the fryer management service through the franchise network. We don't have the GRUs over here or SEAL. That's the company-owned business in the UK. Within fryer management, there's several bits. There's a cooking oil filtration, that they all have that. About 90% of those customers we take the waste oil away from. So that's cross-sold, but it's part of the fryer management service. We are, at the moment, bringing the first GRUs over because we just introduced a new grease recovery unit in the UK, which has now been specified by the only unit to be used by McDonald's, Wagamama's, KFC. So in the UK, the new unit is pretty good. It's won awards. We're bringing it over to the US. A long-term plan for us. It's something we're going to be launching to customers here in a different type of market, but we are looking to cross-sell those into that market as well. So hopefully that answers the question a bit. We could always do more of cross-selling. That's one of the big things we've been doing during COVID, and it's one of the big things we've been working on our customers with.
So when you're trying to break into a new customer, what are their main objections to resisting your service at the moment? Is it that they've got another service, or is it a cost-based decision?
Let's take the States and take fryer management. Fryer management over the years is always a very difficult business to start. It's an educational sell. You have a blocked drain, you phone a plumber. No one's out there saying, do you know what, I want someone to come and manage my fryers for me. The industry didn't exist, so we created that. Hard to start with. We overcame that. People understand now you can outsource that to a company. Once we get customers, so it goes forward a step. Once we get customers, we don't lose customers. You keep them forever. And you service them once, twice a week. So, you build a van, you put another van on. That's a franchisee, nice repeat revenue model. As much as our investors like the repeat revenue model for our royalties, our franchisees like the model because once you get a customer, you service them forever. Unless you're an idiot, they become addicted to you, these customers. The objections at the front end are we do it ourselves. We've got a guy that does it ourselves. Now, I would say for the last 10 years, labor's been an issue in the US. It's been pretty much full employment. So one of the big selling points, ironically, is, well, a lot of your staff leave because they got to deal with the fryers. It's hot, sticky, dangerous industry. We take that problem away from them. We thought that would change right now, but there's a big shortage of staff in the US right now. And our biggest barriers to growth is getting good technicians, because I think I mentioned the price of cooking oil has doubled in the last year. So us actually prolonging the life of that oil is one of the biggest benefits we're seeing right now. So we're growing pretty quickly in the US. We have about 70 ads running in different parts for staff. We're growing quite quickly. So we're coming out of this quickly. And so there's various objections, but we train our franchise owners and our sales team on the phones to overcome those objections. We have a very consultative sell, so we go in and we monitor things in the kitchen and get close to them. And we have about a 60% close rate of monitor to job, and then we don't lose the customers.
Okay, so we're going to be running out of time, and there are quite a few more questions, but let's look at the quality of the underlying franchises and the churn. So compare to where you were before we had coronavirus and where you think we'll be in 12 months' time in terms of the size and quality of that. And then the associated question is all about cannibalizing and density of franchises. In other words, oversaturating an area where you're already present as opposed to putting the resources in another area where there's obviously more incremental growth. How do you handle that challenge?
So let me start by saying, if you took a picture, we would like 100 franchisees with 1,000 vans rather than 1,000 franchisees with 1,000 vans. So our whole model is get less franchisees because our growth comes from existing franchise owners expanding. So when we're in a market, let's take Cleveland or take Orlando here, there's 4 territories. Normally we might have 2 franchisees in there with a couple of territories each. The one that's really performing well, we encourage him to buy out the other one because we get quicker growth from that. So most of our growth comes from existing franchise owners expanding. If you took the final 100 you'd want in the US, we have 140 something franchise owners in the US right now. If you took, so you want 100, we probably have about 40 of those guys quality in the network right now. The others we're looking to upgrade over time. So we're always looking for upsells and the opportunity to upsell, especially guys that don't grow too quickly. We look at getting better quality people in there, and we're doing that all the time.
Okay, so I'm afraid we've only got really a chance for one more question, but it's a follow-on from what you've just said. So you're dealing with franchisees who want to expand. That requires extra working capital on their part. How do you help, or do you not help franchisees with that part of the equation?
So they've got quite cash generative businesses, but when they do look to expand, we have a business enhancement loans. We actually provide centrally as well. They can go to the local banks, but we set up a pool of funds, and for that fund, anyone with 3 or more vans, i.e. they've reached a level, they're reliable, they're not going to go out of business. We don't have guys at 3 vans going out of business. Once they've got that level, they have access to the business enhancement loans, which we give them at a, Brian can tell me, 4% interest rate, 8%.
It's the market rate. Yep.
Market rate, and they pay us back. So, but it's easy for them to get. Ask us, we give it to them, and off they go.
Fantastic, gentlemen. Thank you very much indeed. We will now be moving on.
Thank you.
We introduce the next company. The next company is Henry Boot. It's a main market listed company. It's a market cap of £380 million. It's quite a unique group of companies because it creates sustainable value and long-term growth through several routes in land, property and development, and construction. The business acquires land without planning permission, obtains planning permission, develops sites, and maintains an investment portfolio. And we're really pleased to be joined today by both the Chief Executive, Tim Roberts, and the CFO, Darren Littlewood. Without further ado, let me hand over to Tim.
Thanks very much, Keith. I'm going to start off with our investment case. Then I'm going to give you a summary of our strategy plus our main objectives. And then I'm going to hand over to Darren, who Keith has said is our finance director, who will briefly go through our key markets and our operations. And then you get me again to finish off on Outlook. And Darren's going to be my compare on my slides, Darren. And we're going to go to the investment case first of all. We're focused on 3 key markets: industrial and logistics, residential, and then urban development. And the good news is that those markets benefit from structural tailwinds. We've got a very long record of managing our gearing and balance sheet effectively, and we've come through COVID in a strong financial position. And at the moment, we've got a very strong balance sheet and no gearing at all. The way we conservatively account for our assets means there's significant embedded value across the group. And also, we believe our portfolio is rich with opportunity. And I'm going to go through that in a minute. Now, if you look at the graphs on the right, you can see that, first of all, we've had attractive net asset value per share growth, call it over the last 10 years, but it goes back a lot further than that. And we've also grown our dividend. In 2019, like many companies, we reduced our dividend, but we are now going to grow it again. And between 2019 and 2020, we grew it by 10%. And if you look at the way the net asset value has grown and the fact that we've got a progressive dividend policy, not surprisingly, we generate a good total shareholder return. And our total shareholder return is 13.6% per annum over the last 20 years. And I've not picked that because it's a convenient time period. I've picked it because it's a long time. And if you were to invest in the FTSE, you'd have got 4.6%. So we've performed well. Now, turning to strategy, I'm a relatively new CEO, so it's natural for me to review strategy. And the great news is that the business is in good shape. So it's more about me evolving and the team evolving the strategy. And we do have a need just to tighten our focus on some of our strategic objectives and also get more scale in our 3 key markets. We've got good operating knowledge and skills within the main businesses. The main businesses are highlighted there. I'll go through them. Strategic land, which Keith has told you about, where basically we control greenfield sites mainly. We then obtain planning and then sell on to house builders. We've got a property investment and development business. The development is focused on industrial, which is a strong market at the moment, with some urban development. And that business also runs an investment portfolio, which is made up of completed developments that we've chosen to retain or investments that we are going to purchase because they have some form of redevelopment potential. We've also got a joint venture, which is a regional premium house builder. And that's relatively small, but we've got a clear plan for growth. And I'll talk about that in a minute. And then finally, a construction division, which has a long, uninterrupted track record of profitability. Now, as part of the strategy exercise, what we identified is that we can grow our capital employed. And our aim, and we've been open with our shareholders about this and our teams, is that we want to grow our capital employed by around 150 million. So it'll be just over 500 million. So that's significant growth. We're talking about growing the business by over 40%. We're confident that we can fund that growth by retained earnings plus a conservative amount of gearing. We will be a conservatively geared business. And along the way, we expect to generate attractive returns on capital employed. And you can see our target ROCE is between 10 and 15%. And a key part will be our ESG and people strategy. And to be open with the team and our shareholders, we've set out targets, which are on the next slide. They're clear. We want to grow the strategic land business so that it sells an average 3,500 plots per annum. We want the development business, bearing in mind that 80% of its pipeline is in industrial. And as I've said, that's a strong market, and Darren will talk about that in a minute. So we believe that there's market demand to grow that to 200 million per annum. Our plan is also to restore and then marginally grow the investment portfolio to 150 million. And the reason why we need to restore it is that, and it had nothing to do with me, but I'm pleased to say that we halved the size of the portfolio by an exceptionally well-timed sale of £70 million late in 2019. Well done, Darren, you take the credit for that. And then we've invested it operationally in the capability of our JV house builder. We're growing its land bank and the strong demand for its premium product. And we want to scale up. This is an example where I need more scale. And we have a clear plan to get to 600 units per annum. And then on construction, there the emphasis is going to be keep on doing repeat work. It's a very steady, conservatively well-run business, and it's got a big focus on public sector clients, which is a good place to be going forward. And then, as I've said, there's embedded value within the business, as other than the investment portfolio, we do not mark to market our assets. So our balance sheet is conservatively assessed. And what I've said also is that we've got a portfolio rich with opportunity. And the good news is, as Darren goes seamlessly to the next slide, is that we can deliver this growth by mining the opportunities that are already within the portfolio. And I'll go through this quite quickly. But strategic land, we have a staggering 16,600 acres of land that we control. That's an amazing amount of land. Development pipelines, 1.4 billion. Our share, because some of it's in joint ventures, is 1.1 billion. 78% of that pipeline is in industrial, strong market. Our Yorkshire based house builder has a land bank of 1,119 plots because we've been investing in that. And that's around Yorkshire, but we've got an ambition in the short term to operate in the northeast, and we've bought our first site in the northeast and more to come. And then construction, that's got limited capital employed. We're going to remain focused on the public sector work. And the good news is that we've started the year, we've already got a full order book for this year, and we're building up next year's order book. So lots of opportunity within the business. And then, as I've said, an important part of our strategy will be our approach to ESG. And here we're in two phases. The first phase is that we've launched, under the banner of 135 Henry Boot, our community partnership plan. We did that in March of this year. We've also announced our equality, diversity and inclusion strategy. And then in June, we're going to announce our pathway to net zero carbon. And that's all in the first phase. And then on the second phase, we're going to look at the whole. And this takes longer for us to do because we've got to engage in our people, all our different stakeholders. And we want it to be at the heart of the business. That will be completed in January of 2022. And with that, I'm going to pass you over to Darren.
Thank you, Tim, and good afternoon, everyone. If I can now take you through a closer look at our markets and why we believe they offer long-term sustainable returns. Starting with industrial and logistics sector, we continue to see this as a strong market, which has demonstrated a material increase in demand. The 3-year rolling average for big box uptake continues to trend upwards, with around 50 million square feet of space taken up during 2020, being a record performance. Statistics show that the internet sales as a percentage of retail sales have significantly risen also due to COVID. However, we see this as an acceleration of what was already a clearly identified trend in the chart on the lower right there, leading to a continued increase in demand for warehousing, logistics, and last mile delivery. We also expect onshoring of supply chains to continue and support demand in this market as we emerge from the pandemic and businesses consider supply chain risk. Within this market, 78% of our pipeline of opportunities are in industrial and logistics, and we have potential to deliver around 10 million square feet. In value terms, 50% of this is in big box and 28% in small to mid-size units, mainly focused in the North and Midlands, but also some in the South, which are served by our London office. In addition to this, we have urban residential and urban commercial sites, which are generally located in the main regional cities, which will be dealt with by our regional office network and in a market I'll touch upon shortly. We've also concluded a number of acquisitions this year, which will expand this pipeline. Most of our development activity in the short term will be focused on the industrial market, as this is where we see the greatest occupier demand currently. Here we have some examples of the schemes we're currently delivering. At Butterfield Business Park in Luton, utilising group synergies, our construction business is delivering a speculative scheme of 82,000 square feet for our development business, following the successful delivery of an 83,000 speculative scheme in 2019. At Wakefield Hub, we've secured a pre-let for a 260,000 square foot unit to a German pharmaceutical company, and we recently secured planning for a 2 million square foot distribution warehouse on that site. At Phoenix 10 in Walsall, we're undertaking a significant land remediation programme to ready a 44-acre site for development. That's currently one of the largest projects being undertaken in the West Midlands. The residential sectors proved to be significantly robust against the pandemic, recovering strongly in the second half of 2020 and continuing with all of the major house builders noting strong demand and improved results as annual house price growth hit a 6-year high last year of 7.3% and continues to move forward in the current year. Land values have been relatively stable since Brexit and then continuing with the pandemic, but values are good. Prices have seen some modest inflation in recent years. Demand remains strong, in particular for sites in prime locations and the southern regions. We continue to receive bids for sites at or even above pre-pandemic levels, with the number of bids per site showing a notable increase in some areas. Government support and low mortgage rates continue to support affordability, and with an annual target of 300,000 new homes, the industry has underperformed for some years, resulting in pent-up demand for new product. Our strategic land business controls over 88,000 potential residential plots, with almost 15,500 of these already benefiting from receipt of planning permission. As Tim mentioned, in terms of unrecognised value, it's worth noting that our accounting policy has us value these at the lower of cost or net realisable value, and as such, no recognition of the value gained on the receipt of planning permission is recognised within either the profit and loss account or the balance sheet for these units until they're actually sold. Furthermore, to Tim's comment about our strategic target of disposing around 3,500 plots per annum, our existing stock with planning provides a good springboard to achieve this, with a substantial pipeline of opportunities to backfill as we go. We've also got, as Tim mentioned, a 50% stake in a joint venture house building business. It operates in and around the York, Harrogate and Leeds region with a residential land bank of over 1,100 plots. We're currently delivering around 125 new homes per annum from this business, which has significant potential for growth and expansion to become a multi-region house builder, delivering a premium product in prime locations. In the urban development market, in the short term, we will focus on the urban residential side of this. As I've already mentioned, undersupply continues to drive demand, and in the younger age categories, individuals continue to seek out rental accommodation in urban areas close to work and which provide a living experience. In the short term, we'll have a focus on the build to rent market, which currently accounts for only 2% of the total private rented sector stock. And following the recovery in construction output, we will continue to both develop and build product in this space. Longer term, we believe the workplace is not gone. COVID will lead to many office environments being reimagined, but as a place for collaboration, training and sharing of ideas. We strongly believe that our city centres are not dead and will continue to outperform additions to GVA and population growth. We will take a medium-term view of this, but fully believe that quality new product in prime locations will be in demand as the recovery takes hold. Currently, we're delivering Campus, a 534-unit build-to-rent scheme in Manchester for an international fund in which we retain a 5% equity stake or 11 million in GDV terms. In Sheffield, we've been awarded a construction contract for the Kangaroo Works, a 364-unit build-to-rent scheme with a contract value of around £40 million. And at Cornwall House in Birmingham, a site we acquired last year, we hope to receive planning shortly and start on site with a £32 million build-to-sell scheme in the second half of this year. Finally, I'll hand you back to Tim for an overview of our outlook before Q&As. Tim.
Thanks, Darren. So just to finish off, we've seen a steady recovery in our markets. Our balance sheet is rock solid with no debt. And from this position, we've been able to make selective investments, which will be profit for the future. In terms of the short-term outlook, we've had a very good start to the year, with having already pre-sold over 2,300 plots in our strategic land business. Our committed developments are 88% pre-sold or let, so we've got capacity to commit to other schemes. Our JV house builder has secured 57% of sales of its year's target already, and a construction order book that's full. And in the long term, we're very much focused on the 3 sustainable markets: industrial and logistics, residential, and urban development. And we've got clear medium-term objectives to grow our business, and I'm confident we can achieve those and continue to generate attractive returns to our shareholders.
Now, the first question is basically, I think this is Tim. Any CEO who takes over a business before pandemic strikes must have learned a lot of factors. Despite the fact you've talked about your strategic objective, what have you learned about Henry Boot and the people that work there? And is finding adequate human resources a limiting factor in your growth for expansion? Sorry, that's a slightly complex question.
No, well, I think that's a great question, isn't it? I mean, I've found a skilled and engaged workforce, and we've been around for a long time, and I don't know whether our legacy has got something to do with that. What I also like is that there's some commercial acumen. So we find deals, and we've got a long history of generating a strong return on capital employed. And it also means we've got lots of opportunities. And in the real estate business, you sometimes find that companies can't really grow because they can't find the opportunities to do it. We've done that, and I think I've given you a good glimpse of all our opportunities. I think just to be balanced, I think that the business has now big enough so it needs to be clearer on its strategy. And I hope by letting you all know what our ambitions are and setting them out, and we will mark ourselves against those ambitions with being clear. And in terms of HR, I think that the market will become more difficult to attract people, because the economy, I suspect, is going to be pretty strong. But if you keep on managing to treat people properly, treat customers properly, give people interesting projects to do, deal with them properly, which Henry Boot's got a great record doing that, do you know what? You'll find people.
Okay, so the next question relates to your recent acquisition activity. So Henry Boot has made a number of real estate investments in recent weeks. Are you buying when others are fearful? And is the risk profile of the group changing?
Yeah, I think that because we are focused on 3 markets that have got through the pandemic pretty well, and have definitely got long-term sustainable characteristics, we wanted to, first of all, get through the first part of COVID safely and securely, and then we wanted to invest some money. And we started to do that in earnest in the second half of last year. And what I think you're seeing in the flurry of press statements on us buying a beautiful prime site in Birmingham and 2 industrial estates is the result of that work last year. And we bought things last year. We bought nice income producing buildings with redevelopment potential in Manchester and Leeds last year, you know, great cities in the north. So I think that it's a lovely question because it pays us a compliment, doesn't it? But we're not the only people doing it, but we're in a good position. And then in terms of risk, no, we will carry on being thoughtful about risk. The big thing that real estate businesses are going to be thoughtful about is gearing, and we will either, at the moment we're not geared, but as we grow we will gear, but we will be conservatively geared. And as we take on operational risk, because the gearing is financial risk, as we take on operational risk, we'll be thoughtful about the levels of our pre-sales and the levels of our pre-lets and the levels of land that we've got planning. And again, I think that in the operational update that Darren gave you, you can see that every time we're buying something, we're also thinking about passing on some of the market risk by pre-letting, pre-selling or reservations.
So the follow-on question from that is, are you in competitive situations when you're making acquisitions, and how do you decide where the max limit on pricing is?
Yeah, well, we are in competitive situations. I'll give you the three markets. So industrial is very competitive. So if you want to buy an oven-ready piece of land, you would be competing with lots of developers and institutions and American and Canadian pension funds. If you look at what we're doing, we've got some oven-ready stuff, but we're making it and we're baking it. And that's what we will do. We will buy stuff that's more complicated. And Darren talks about Walsall. There are not many people with the skills to remediate that site. So that's competitive, but we'll find our niche. Residential, that again, pretty competitive, but we're either long-term buyers in strategic land, which is less competitive, or we know our onions in Yorkshire and then on urban development, I think urban development is the part that is not so competitive, because people are a bit worried about the cities and the fact that the pandemic seems in the short term to have moved people out. And we will buy some interesting sites. We've bought some interesting sites. And as Darren said, look, I think that the idea that this trend that's been going on for 2,000 years of cities growing, I think the idea that cities are going to start to shrink, they might, but over the medium term, there are too many attractive things in the cities that will continue to attract businesses, institutions, and people there.
So in the industrial and logistics area, what factors do you consider when deciding whether in fact the sector is getting quite hot? In other words, there's a huge amount of capital coming into a limited market and you decide the value isn't there anymore. Are we anywhere near there?
Well, you got to look at macro supply and demand, first of all. And at the moment, the macro supply and demand looks as though it's balanced, and if anything, in favour of the provider. Then you've got to look at the micro markets, and there might be a lot of supply across the country, but I'm making this up now, no supply in the Eastern Midlands. So we will study that market. We will also, notwithstanding those supply and demand characteristics, we will look at the returns that we can make. And typically that will be an internal rate of return or a return on profit. And we're experiencing this now. There will be some sites that we put bids in for and don't get them. And there will be some sites where we don't even put bids in. And I think that what happens is, as the market becomes stronger, you become more selective about what you buy. And look, it is a strong market, but it is a long-term market. And don't forget, Henry Boot has got a big pipeline. So a lot of our opportunities were bought when land was cheaper. And land is the big variable. Yeah, so if the end price goes up a lot, the cost of building it doesn't go up a lot. It's the cost of land, and we've got that land, or we control that land already. So look, I think we're in a good position. Okay, so we only got time for one more question. It's about house building, and the question is very simple. Would you like, Darren? This is coming your way because you definitely answer the question. Okay, so it's the same. It's a similar question for house building. How exciting is house building, and how? Darren, go on. You know the answer better than me in any event.
House building's an incredible market at the moment, isn't it? All of the house builders post-pandemic have come back into the market. They're showing good results, good levels of demand. We're seeing that in our house builder. As Tim mentioned, we're 57% reservations taken for the full year already. The market itself is probably constrained by the ability to gain planning permission and the difficulties of that system in the UK. And if that can be eased up, then that will hopefully allow the UK to start delivering the kind of numbers and targets that it's looking for. For us, it's a really exciting time at the moment with our house builder. We're looking to expand it into the Northeast, following that into the Midlands. And as Tim's alluded to, we think over the medium term, we can get that business up to doing 500 or 600 residential units per annum.
Gentlemen, I'm afraid that's all we've got time for. Thank you very much indeed.
Let me start to introduce the next company to present. which is Helios Underwriting. So this is the only listed investment company offering investors growth and returns from exposure to Lloyd's of London. We've all heard of Lloyd's of London, but it's quite difficult to invest in if you're, for example, a retail investor. So this is an AIM-listed investment company. It's got a market cap of 60 million, and it offers growth and returns by building a portfolio of underwriting capacity at Lloyd's through the acquisition of some high-quality limited liability vehicles, as the guys are going to explain in a minute. The LLV structure replaced the famous Lloyd's name structure at the start of this century, and many of these vehicles are coming up for sale as their owners and founders age and decide they want to cash in their chips. We've got two speakers today. We've got Nigel Hambry, who's the Chief Executive of Helios, and we've got Arthur Manners, who is the Finance Director. Gentlemen, over to you.
Keith, thank you very much, and thank all the listeners for sparing the time. Can I just correct one thing? Our market cap's 110 million. Just to
I do apologise
for the record, but I think that's probably since the we've had a couple of capital raises. But everything else, your introduction was extremely accurate and does it much better than I do. But as you said, I'm the CEO and Arthur is the FD. And together I've been in the market 40 years, Arthur's been in it 20. I was on the capital side throughout the last 40 years and Arthur on the underwriting side. So with any luck, in that combined 60 years, I hope that we have learned something. So before I get on and talk about who is Helios, I'm going to say just a few more words to add to Keith's explanation of Lloyd's and our place in it. It's a specialist subject of a huge number of people, but I'm going to keep this to about 1 minute. And basically, Lloyd's is the provider of insurance throughout the world on really difficult and complicated and specialist risks. We're probably not so good at insuring a house in a street or a shop front or whatever, or a motor car. But if it's difficult and complicated, then we should be on it. And so, for example, we will have exposure to that ship that got stuck in the Suez Canal, or we will have exposure to wildfires in California and the big freeze in the US, directors and officers, and of course, the sort of dreaded cyber. But those are the sort of things we do. And if you think about insurance for 1 minute, what we're doing is we're offering a promise. And if you're offering a promise, you need to be absolutely sure that the promise is delivered on when it's called on. So therefore, you need to have a lot of capital. And the capital is provided to Lloyd's through what I call first-party capital providers, like the Beazleys and the Hiscoxes and the AIGs and the Munichs and so forth. Straightforward insurance companies, and most of the brand names in the world will have some sort of involvement with Lloyd's. Or the capital is provided by third-party providers, chiefly private investors. And that's where we come in. We are one of the largest third-party providers of capital. And the difference between first party and third party is that we don't have people issuing policies, paying claims, managing a brand, setting up offices abroad and so forth. We are pure and simple. We like to get directly into underwriting risk without any flim-flam on the side. We are third-party providers to these experts like the Beazleys, Hiscox, and so forth. So now on to that first slide, which is who is Helios? Well, we are a leading consolidator of that third-party capital in Lloyd's, and there are thousands of them. And our universe is probably about 1,500 individuals who still trade at Lloyd's, down from a total of about 32,000 in its heyday back in the 90s. And these private individuals, private investors, they invested through ups and downs. And there was a moment when the World Trade Center event happened. And that followed quite a few years of very difficult underwriting conditions. And they made a very tough decision to stay in and continue underwriting in 2001 and onwards. And they've been amply rewarded by 16 years of profits. But what's happened is that they were probably in their 60s in 2001. They're now in their 80s. and the costs have risen and the hassle has risen, and many of them wish to sell their vehicles. Their vehicles, they started from scratch and generally, and now they are worth £1 or £2 million a piece. And as I said, our universe is about 1,500 of these vehicles. So we have bought quite a number of them already, and we consolidate them into and have created a diversified portfolio of insurance risk. And we are pretty picky, as you would expect from 40 years experience in the business. It is very important to go for absolute quality. So we've put together already a portfolio of the top performing syndicates through a listed company. And that portfolio has outperformed every year without exception. And anyone can outperform in a risk business in good years. You just take more risk until you don't outperform when the bad years come. So I'm particularly proud of our outperformance in the difficult years which we've recently had. And because of our size, we have available to us a flexible reinsurance program. And as we were growing over the last few years, we used that ability to buy reinsurance to its maximum. And we basically laid off, like a bookie on a race course, we laid off most of our risk. We didn't know COVID was coming. COVID is an insurable risk. We didn't know COVID was coming, but we knew times were difficult and we wished to lay off that risk, which we did. And it's been very effective in protecting us from COVID losses. So right now we're refocusing not refocusing, we are focusing our business on buying out more and more of these old investors' vehicles. And these vehicles contain some lovely syndicates and nice assets. But it is capital intensive, and we've had a couple of capital raises over the last few months, and we'll talk about more of that in a minute. But the effect has been to allow us to increase our risks very, very substantially, our exposure to underwriting at the right time. Now, this shows is a list of the major entities that we support. Some of them you will know about, like the likes of Beazley and Hiscox, and some you've probably never heard of at all. But these are quality outfits with quality renewal books of business. And we have a stake in each of them in varying sizes. They're substantial underwriting businesses. And for most of these participations, we have rights of ownership. They're called preemption rights. So when those syndicates, these entities wish to grow, they have to give us our share. And so we can't be diluted, we can't be selected against. These are very, very valuable ownership rights, which we have. And at the bottom of that slide, you see the outperformance, which I think is sometimes a little bit embarrassing, but it's delightful when we compare our results in Lloyd's through good and bad years.
Thanks, Nigel. So the insurance market is a cyclical market. It depends on the amount of capital that comes into the market. And since the market cycles last about 20 years, so it was in about 2001 that the prices rose substantially last. And they rose after the World Trade Center and after about 4 years of losses. So we've now just had 4 years of losses from underwriting years 17, 18, 19, and even maybe 20. There's going to be a marginal profit. And COVID has been the straw that broke the camel's back, and now the rates have been going up substantially. So the rates for the premiums that were written, or the risks that were written in 2018, the underwriters are now getting 30p per pound of risk than they were getting 4 years ago. So if they were breaking even on the underwriting in those years, if they're receiving another 30p, the prospects for underwriting profits are now substantially better. And the insurance cognoscenti, and we'll come to the people who have supplied us capital, sort of understand this. And they realize that with the additional money coming in, which they've got to pay the claims, they've got to pay their expenses, there are going to be better returns to shareholders. And we expect these rate increases to keep going in 2021 of about 10 and 12%. And then after that, we expect those rates to flatten off, and then the rates will slowly decline over the next 5 or 10 years. So we do see sort of 5 to 10 year period of where we can achieve superior underwriting profitability. In terms of the lines of business that have shown the biggest rate increases, that is on the US financial institutions have been charged a lot more money. The directors and officers insurance, particularly in the US, they're having rate rises in excess of 100%. And where there's been COVID exposures in terms of the employment practice liability and the medical malpractice, those rates are going up. There's not that there is, and this has been driven largely by a shortage of fear and a shortage of capital, and that will sort of start to reverse. And so this is the opportunity to move the business forward, and that is exactly what we're trying to do.
Thanks, Arthur. And I think that this is the sort of the business case. What is the business case for investing in Helios? And as Arthur has said, we are now in a hard market, and it continues to harden. And this is the fourth hard market in my 40 years. So I'm thoroughly enjoying it. In a hard market, you need to increase the amount of risk you retain on your books. And we have the ability to do that. Because of our size, we have available to us not just the reinsurance arrangements that I talked about earlier, but a whole range of tools. And the tools are most effective at either end of the cyclical market hardening or softening. So if it was a dire times and the rates were terrible and the claims were too much and so forth, then the tools available to us would be to buy stop loss, and we would emphasize on that. At the opposite end of the market, the tools available to us are gearing mechanisms, and of course we are using those, and our competitors don't have access to them, or don't have access to them at the same terms as us. Similarly, many of the costs in our market are flat. You pay the same as writing £1 million as you do for £100 million. And so there are enormous benefits to size. And there's something else, which is not so much a monetary cost, but there's a hassle factor of running these vehicles. We're paid to do it, and that's what we do. That's our day job. But private investors find the regulatory regime has got so harsh now that they just throw in the towel. And those costs, they're not worth it for writing £1 million. So there is the LLVs available to us are clearly increasing. We also benefit, because of our size and because of our quality spread, from below average capital requirements. And the amount of money we have to put up to write £1 of business is about 48%. And a lot of other people are had to put up between 60 and 100%. So it's a very nice capital arbitrage, if you like. It's also quite timely as far as the tax environment is concerned for vendors of these vehicles. Now, I guess many of the listeners will be much more attuned to this than me, but on the whole, these vehicles are all capital gain. And we have a 20% capital gains tax rate, quite a favorable corporation tax rate currently for disposing of assets within the company. And in many cases, and in fact, most cases, they have the old entrepreneurs relief, now called BADR. So, and none of us know quite how long those rates will last. But so someone who is a bit nervous and a bit old might well say this is not a bad time to cash in. We have also reaffirmed our dividend policy, and we have been paying dividends. We had a small break with COVID, and we're now reaffirmed a 3p per share sustainable dividend, supplemented by special divvies as the profits come through from time to time. An important point about insurance, again, people who manage investment portfolios, we do add a significant degree of diversification. Insurance risks march to a different tune to other cycles. And so Helios does provide this diversification. It's asset-backed, as I think Arthur's mentioned. We're dividend paying and we provide this diversification. And finally, on this slide, I would say that point out that our shares are eligible for business property relief as far as IHT is concerned.
The company structure and our recent capital increase, as you say, we are an AIM-listed company. We've raised £75 million in the last 9 months in 2 capital raises. We have persuaded 3 substantial investment managers to participate in the company. As ILS Capital, is Bermuda-based, Hudson Structured Capital, in Bermuda, and the Polar Capital Insurance Fund. And the Polar Capital Insurance Fund, they have about 30 different holdings within their fund. So we were delighted that they understood the opportunity that the Lloyd's market now presents. So all 3 are specialist insurance funds, and believe that there is the prospect of building shareholder value over the next 5 years with this rate increase and with our participation in the better managed syndicates at Lloyd's. So the shares at 110 million, we know we've still got a bit of a hill to climb, but the shares have been re-rated and there is now better liquidity in the shares than there was 12 months ago. And we see our key metric in managing or measuring the growth in shareholder value is our net asset value per share, and that currently is around 150p per share.
Thank you. So to finish, we have significant opportunities for growth now. The skill of a cyclical business is not, and in an insurance market, you don't get a hard market without losses. The skill is not to lose your shirt during those losses, which we didn't. So we have raised the money. The money is intact. We have plenty of places to deploy it. The first, as we've described, is the acquisition of LLVs. We are in the midst of that now, and that is our number one concentration at the moment. We can also increase our retained capacity by reducing that reinsurance I told you about earlier. It's actually called a quota share reinsurance. That we have 47% of our portfolio is currently underwritten by others, and we can reduce that as we see fit. Then I mentioned earlier the rights that we have. Well, all those syndicates that we support, they see a great market, they see opportunities to write more and better business, and they will be growing their businesses and giving us our share. So we expect significant preemptions on these highly sought after syndicates that would cost an awful lot of money to get on, but we get them for free. These rights we get for free. And lastly, there is, in a hard market like now, when it turns, there are all sorts of businesses that are essentially first party, but they like third party support from people like us, in that we are, dare I say it, knowledgeable, but not competitive. We're not going to look at their books, see the classes of business they're in, and then go off and set up ourselves in competition. And people like to have a spread of capital support. It gives more power to management, and we like to provide our money in that way. So we're armed, we're ready to go. The pot of money is intact, and we think it's a really exciting time for us to be in this game. thank you all very much. Delighted to take some questions.
Gentlemen, thank you very much. You'll not be surprised that a lot of questions are related to the experience of management is absolutely critical in a highly cyclical business. So would you like to explain what you've learned in previous cycles, and if the current cycle doesn't move as expected, what action can you take to mitigate risk?
Right. Well, I think the lessons that I've learned in 40 years of this business are seared into my brain through these varying cycles, but they do have certain common denominators. For example, anecdotally, when people start telling you the cycle is over, we're no longer cyclical, this is the new normal, you know you're getting close to the cycle turning. And you then listen to the likes of, I think, Warren Buffett, who says, or might have been a Rothschild years and years ago, saying you buy to the sound of gunfire and you sell to the sound of violins. So you've got to get over your fear and play again counter-cyclical. But as I said in my presentation, I think that we were very cautious and rightly cautious as we grew in a very difficult market. And so we did buy this quota share, which simply took away 70% of all our exposure. And the 30% that remained with us, we bought a stop loss on. So as we waltzed into COVID, we were not the least bit fast. We didn't know it was going to be COVID, but we knew there would be a loss of some description. And so when we raised money, we were not plugging a hole. The money was there to help us grow. So, and the second part of your question is, if it doesn't go according to plan, well, we'll have to respond when we see why it's not going according to plan. Every cycle is slightly different. And I won't bore the listeners with the fact that the reinsurance market is not going any as hard and as fast as it has in previous cycles. But the insurance market is there for all to see. And that many of the listeners will see it in the rates that they're being asked to pay for the D&O and E&O and other stuff that they are having to buy. And so we will respond to whatever comes our direction. But right now, the insurance market is hardening and has hardened and is continuing to harden in exactly the way I would expect. And I think in possibly a more mature way. In previous cycles, we have had lots of people going bust. We've put a naught on the end of the rates. Our reputation has not been well served. This is a much more mature hardening of rates, terms, and conditions.
So over the next couple of years, let's just go over a couple of points. So there's a chance of increasing capacity. Would you be buying more LLVs at the expense of retentions, or would it possibly be the other way? And how flexible are you in that equation? This leads to another question about LLVs. Do you actually offer them shares, or is it always cash? And how do you value these businesses, and how many of them do you pass on, having had a look at them?
These LLVs, they have three main assets. They have the capacity rights, those freehold capacity rights, which are traded, and there's a value attributed to those. And those values have been reasonably steady. They have the funds at Lloyd's, the capital in those companies, which you can see what they are, and that's lodged in Lloyd's, and we buy that with the company. And thirdly, you have the pipeline losses at the moment, is pipeline profits or losses, and we put a value to those. So they're relatively straightforward businesses to value. We make adjustments for tax, and then we like to buy these companies at a small discount. But given the prospects at the moment, maybe those discounts are going to narrow a bit.
Your other question was, I think, a really good one, and it would take at least another 15 minutes to give it justice. But whether we prioritize LLVs over increasing our retained, and it is complicated. I think I would say you have to take the tricks while they're available, and adjusting our retained in the quota share is available to us anytime. That's our behest, this year, next year, sometime never. The availability of LLVs to buy is now. And we are the only people famous last words doing this. And we the first mover advantage, I think, is really quite considerable. And I guess that the LLV purchase game will largely be over in 3 years.
So we've got a number of questions from Miles, but I'm just going to deal with one now because unfortunately we don't have a chance to ask any more at the moment. Please discuss in a rising inflation interest rate environment how the following interact: rising costs of claim, higher income from invested premiums, and hits to NAV from marks to market.
Another good one. Arthur, do you want to, because I do remember inflation when it was really, really high some years ago. But Arthur, carry on. Yep.
So, a point to make clear is that the syndicate managers, so we are participating in business which is are substantial businesses, and they have their own management teams. And most of them, the funds that are managed or looked after on behalf of the capital providers are managed by those syndicate managers. And they are very aware of the risks of rising interest rates and the potential for losses on bond portfolios on that. They would have their own risk appetites, which is agreed at their board level. Nigel and I, you're looking at two out of the three employees at Helios Underwriting. We don't get involved in the management of the underlying businesses. We are merely passive capital providers. So being managers of risk, the risk is not only the underwriting risk in terms of claims, it is also the investment risk. And every single of those businesses are very aware of that. In terms of inflation and claims inflation, there's been lots of discussion in the insurance market about claims inflation and social inflation, particularly social inflation in the US. Again, it is the managers of the syndicates themselves who then have to assess the loss trends, the potential losses on their portfolio, and the likely premiums that they have to charge to cover those loss trends, and whether they're going to make any money out of that business. Yes, it takes a few years for that to materialize as to whether they are or not making money. But with the recent rate increases, the comments are going, there is now rate adequacy in terms of both the inflation and social trends that they are experiencing at the moment.
Gentlemen, thank you very much indeed.
The final company to present today is a business called Emmerson. It's AIM listed, market cap of about 50 million. Hopefully I got it right this time, like last time. And the primary function of Emmerson is to develop a project in northern Morocco in potash. It's recently completed a feasibility study which confirmed the findings that the project's the potential to be world-class, low capital cost, high margin. It's a very rare asset in this industry, and I'm very pleased today to be joined by Graham Clark. Graham's the CEO of Emmerson. Graham, over to you.
Thank you very much, and hello everybody. Okay, right, so I'm going to talk today about our project, the Chemiset project in northern Morocco, and it is a potash development project. These are the highlights here on the introduction slide. So really the fundamentals behind the project is the increasing demand for potash. That's increasing demand for fertilizers in general, and there's a forecast trend around 2 to 3% per annum increase in demand for potash. And potash is one of the key fertilizer nutrients that all plants need to grow. So we believe the fundamentals completely support this with the world's growing population. And that offers the opportunity for new, well-located sources of supply. And where we are, northern Morocco, with access to the Moroccan market, the African market, which is growing substantially, and also from the port of Casablanca, access to all of the major fertilizer and potash markets around the world, we're actually strategically located. And that feeds into the outstanding project economics. Those are driven by the low risk of development because of the geology, and also the logistical advantage of the location. I'll talk a bit more about that as we go through the slides. We have a small team, but we have all of the key development expertise in place, and we'll add to the team as we move forward towards construction, which the target for that starting is the end of this year. And currently the share price is definitely undervalued compared to where we are on the development pathway. So just talking a little bit more about the fundamentals behind the project. So growing world's population, less agricultural land, we have to grow more food. And by 2050, the world has to produce 60% more food than it's actually producing today, just to feed the growing population. The only way to do that is to increase yields. The only way to increase crop yields is to apply the right fertilizer in the right quantities. And the little graph there on the right-hand side shows how the application rates have increased over the last 15 to 20 years. But this has to increase further. That's an average, and Africa as an example, where there's a lot of the world's available agricultural land, the application rates are about 1/10 of the average around the world. And there is this huge need for increased production and sales of fertilizer and therefore potash. We do say it's a strategic asset. That is because of the location and also how it feeds into the market. But in Morocco, agriculture is really important in Morocco. It is one of the key parts of their economy, and the government put a lot of money into developing agriculture in their Green Morocco plan. And that's to improve methods, mechanization, and also understanding of the need for fertilizer and the application of fertilizer in the country. And then if you look at Africa as a whole, where there's expected to be a huge increase in population, African farmland has got to become really productive, and Africa will have to become a net exporter or a large exporter of food going forward. So there will be a huge demand for our product locally, both in Morocco and in Africa. And the graph there shows the increase in imports of potash into Morocco since 2012. And Morocco is now importing close to 1 million tons of potash into the country. And this is driven to a large extent by the large phosphate producer, OCP, the world's largest phosphate producer, who are based in Morocco, who have started to bring in potash to blend with their phosphate products to make multi-nutrient fertilizers for sale in the fertilizer market. So we have a great advantage of being in a country that currently is importing more than the annual production of our project when it's in operations. Talking a bit more about Morocco, it's a very stable jurisdiction. It ranks very highly, certainly in terms of Africa, is one of the most stable and attractive countries for external investment. And the country welcomes foreign direct investment. There's a lot of investment in industry and also in mining. And the country with a mining heritage with OCP understands the mining sector. They have a very favorable royalty scheme in place where we would just pay nominal royalties, and they understand the benefits to the economy of mining and are very supportive of our project and other mining projects in the country. The infrastructure in Morocco is very good. It's very well established. We're very close to the main power distribution network, but our plan is to use 100% renewable energy. That's our target. And there's huge quantities of both solar and wind energy in Morocco. And we're already engaged with one company who is offering us a supply, and there are other companies continually going into business developing renewable energy in Morocco. So power supply and green power supply is readily available. We've looked at the outputs of the project in terms of the benefits to the economy, and this is one of the reasons why the authorities, the government in Morocco, have been very supportive and encouraging of the development of our project. We're going to create just under 2,400 jobs in construction, and then around 1,500 jobs, direct jobs, once we're in operations. And we're targeting to fill a lot of those with local labour, and we will have a significant impact on the local and regional economy once we're in operations, with an expected increase in GDP per capita locally of around 40%. Just summarising now why the project economics are so good. This simple graphic here compares the development of the Chemisett project, the top half, to a typical potash project in Canada, for example. So in terms of the geology, it's very favorable. We have no aquifers, so no water-bearing strata between the surface and the resource that we want to extract. And it's also relatively close to surface, around 500 meters below ground level. So we can access the deposit with two ramps, decline roadways, around 3.5 kilometers long, going from surface, angled down into the potash deposit, mined using conventional equipment without any issues with water. And the cost from the feasibility study of that is around $35 million. A typical potash project in Canada and other similar mining projects, the now Anglo-American X-Sirius project in the UK, deep shafts having to go through aquifers, which is high risk and high cost because you either have to freeze the ground or grout the water-bearing strata as you go through it. And the typical cost of accessing the deposit would be around $1 billion. So a massive difference for us. I've already mentioned the great infrastructure already in place in Morocco. We're very close, less than 15K from the power distribution network. There's a highway passing the site. So we're easy to connect up to the power. And also for taking our product from the site down to the port of Casablanca by road, we have the highway running past the site. So it's a simple junction to establish that access. Typically a Canadian project with connection to a rail link and to power, there'd be a couple of $100 million to spend on infrastructure, whereas our cost is less than $13 million. Our logistical advantage, once in operations, is really key to our low costs, and we'll be right down at the bottom of the cost curve in terms of potash production. We're 130, 150 kilometers to the port by truck, and then from northern Morocco, we can access all of the main potash markets. For the purposes of this, we just use Brazil as an example, which is one of the big markets for potash. We can get our product from the site to the market in Brazil for $24 a ton. If we look at a Canadian producer and the existing large Canadian producers who are really big players in the market, they're typically around 1,700 kilometers from a port. So high cost of transport to the port. They pay high royalty payments. Their royalty payments in Saskatchewan in Canada are actually $25 a ton to the Saskatchewan government, which is higher than our total cost of shipping to Brazil. And then they have to ship from Vancouver by the Panama Canal to Brazil, and their cost would be $105 a ton compared to our $24 a ton. And this is why the project stands out once it's in operations, because we have access to all of the potash markets at a substantial discount to the competition. So the combination on this slide of the geology and the location means that we have a low cost, low risk development, and then the significant logistical advantages of being in northern Morocco, having access to all of the main markets. And this is really what fed into the outputs of the feasibility study, which was completed last year. And this is just a summary of the main metrics from there. What we've done here, though, is look at a couple of cases for the potash price, because that does vary. The forecast that we used in the feasibility study was a long-term potash price of over $400 per ton. But here, for the anticipated mine life and annual production and costs, we've looked at a potash price of a very conservative level of $280 a ton, and probably what is a more realistic base case of $360 a ton. But with a 19-year mine life, and that, I have to bear in mind, is just from less than half of the resource that we have available, so we anticipate a life of probably double that in reality. Annual production of 735,000 tons of potash and 1 million tons of de-icing salt as a byproduct. CapEx of just over $400 million. We have a payback of less than 3 or less than 5 years in the conservative case, making significant margins, and an NPV of over $1 billion with a potash price assumption of $360 a ton. So it really is a great project. And because of our low cost of production, so our all-in sustaining cost to deliver the product to Brazil puts us right down at the bottom, towards the bottom of the cost curve at around $160 a ton. Recently, we have done a piece of work just to look at whether there is potential to phase the development of the project. So this has two elements. One, we have had a look at whether we could start with a smaller scale project and that appears to be the case in the scoping study level work that we've done. We haven't done the level of detail as we obviously have with the feasibility study, but we could produce a project producing around 350,000 tons of potash, and that would have a reduced capital requirement of around $255 million. But more importantly, from our point of view, what this work identified is how we could increase the output and expand the project to bring in multiple products, bring in potassium sulfate, a higher value potash product, and also additional salt, and ultimately to expand the level of production of potash as a whole. So our phase 4 from this work would give us earnings per annum of around $490 million and an NPV of 2.37 billion. So lots of opportunities to expand the project, and if we needed to, the opportunity to start with a smaller production model. The project has moved very quickly over the years. I joined in July of last year, but a lot of work done prior to that and then subsequently. The highlights really was the feasibility study in June last year, which identified and proved the outstanding potential of the project. Since then, we got the mining permit in February of this year, which is a really key milestone for the project. And what the mining permit, the mining license means is that the Moroccan authorities have identified that we've done the exploration, we've got a confirmed resource, and it's economic to extract, and that's demonstrated by the feasibility study. So they awarded us the license in February of this year. Moving forwards in terms of the near-term milestones, the next big one is to get our environmental approvals, and we expect that in the first half of this year, so this month or at the beginning of next month. We have been engaging for some time with potential strategic partners, and that is a key step for us to bring somebody in to partner us in the development, either as an equity investor, or as a partner with an interest in the product. And we've already been working for some time on putting in the debt funding structure for funding the project, and the aim is that we pull the funds together before the end of the year. Q3 is the target, so that we're able to commence early construction works before the end of the year. And whilst that's an aggressive target, it is still our intention to do all that we can to meet that. And then just focusing a bit more detail on what's going on at the moment. Recently, we moved to AIM, and we believe, given our sort of current size and strategy, this is gives us access to a market environment which is more suited to where we are and what we need to achieve. We will be starting in the next week or two some site investigation work to provide the detailed data to go into the engineering design for the site infrastructure. We'll be doing some more site drilling in the next 2 or 3 months. We'll be drilling down the route of the declines so that we can get detailed information to go into the detailed design for commencing the decline works next year. We're also doing a detailed feasibility study on the potential to convert some of our potash product, the MOP, into SOP, potassium sulfate, which adds a lot of value to the project. And also we're commencing engineering design work, and we'll be bringing in, as I commented earlier, additional team members to take us forwards into construction. And then just as a final slide, I'll leave this one up for now. One of the key things, and we talk about the way we've approached the environment, using renewable energy, and the way we're developing this project is by doing the right things and doing them in the right way. And that's a very simple summary of our values as a company, and the way that we're working with the authorities in Morocco to deliver the best project we can with the best value for all of our stakeholders. With that, I'll finish talking and happy to answer any questions.
Graham, thank you very, very much for that. I think the first question relates, or a number of questions relate to the strategic value of Emmerson. And I think what would be helpful on the background of your presentation is to talk a little bit more about how the fertilizer companies and the potash companies interact on a global basis. Give us some idea of how many big players there are, and that will help explain what the strategic value, I think, of Emmerson is within that framework.
Okay, so there's nine potash producing companies produce over 90% of the potash in the world, and the global consumption's around 70 to 80 million tons per annum. So it's a really well controlled market, and 5 or 6 of these large players are also fertilizer producers. So every plant needs 6 macronutrients to grow, but the main 3 that are applied in NPK fertilizers are nitrogen, phosphorus, and potassium. So K is the potash. So if anybody goes and buys some Miracle Grow or whatever to put on your garden, it'll be an NPK fertilizer. So quite a few of the potash producers are also NPK fertilizer producers. So they produce and the fertilizer market's around 800 million tons a year. So it's a massive market. So they feed into that. But there's quite a few of the fertilizer producers don't have their own potash. So the likes of Yara, for example, a Norwegian company, have all of the nitrogen they need from the oil and gas, but they don't have the potassium. They have to buy that from their competitors in the fertilizer market. OCP are another example, the world's largest phosphate producers in Morocco, also produce NPKs. They have to buy their potash from their competitors. So we, as an independent in that market, we have a very valuable product because it is very attractive to fertilizer producers who currently are buying from their competitors. So we offer, that really is a trump card to us at the moment in ongoing discussions with potential strategic partners, that we have product that, we're not competing with them in the fertilizer market. We do have a great advantage.
Thank you. Can we just go back to the political and constitutional framework of Morocco, because I don't think many people really understand. What reassurance can you give investors that this will not be a problem, either from a tax regime or nationalization problem, or a government issue, or anything that could destabilize the whole project? I understand the government's obviously very favorable towards you and what you're doing. The question is, are there any counterforces within the political or constitutional system that could upset that?
Well, we don't believe so. I mean, the attitude has been and is currently, they're very encouraging, they're very straightforward. Our project is of regional and national importance. The economic benefits that it delivers, they see. Therefore they want it to work, and they're helping us get to that point that we can get it into production. They've given us the mining license, so they obviously trust we have the capabilities to deliver the project. There's many mining companies operate in very similar circumstances to Morocco, and in Africa, Morocco is amongst the most stable jurisdictions. There's no question of that, and it's very attractive. There's a lot of large overseas companies, car companies, invest in Morocco because it is stable. So, we really don't see any suggestion that changes. They understand what the project will bring, and they see us as a company that can deliver that benefit to the country.
Okay, so if we move on to the funding side of life, the project funding side of life, which you referred to, this is a question from Stephen. How is the debate developing, really, all-in versus phased development amongst management, and particularly amongst the banks and strategic partners? And you might want to weave into that answer your attitude towards the debt equity balance.
I can't say too much about certain discussions that are ongoing, obviously, but one thing that has sort of stood out with ongoing discussions with potential strategic equity partners, and particularly those who have an interest in the product, is that they have an interest in a substantial output. So the larger scale project is more attractive to those parties. That is clear. So obviously that will be our focus, and we're talking about and strategic partners here who can put a lot of the funds in that we require to develop this project. So the larger project makes more sense in regard to that, and that is sort of in our focus. In all the presentations we give, we talk about the need for a strategic partner to help us with the equity side of the investment required. And if there's an interest in the product, then obviously the larger project is the way forward. In terms of the debt to equity ratio, We are looking at around 70 to 30 debt to equity. That's the target, and our advisors are pretty confident that we can achieve that. And there's discussions ongoing with banks from the debt side of that, and also with export credit agencies who are very interested in the project. And we are in sort of engaged with 2 or 3 ECAs who understand the project, understand mining projects, and are very interested in supporting the project with the export sort of guarantees that they put in place, which obviously then help with the banks and securing the debt.
Okay, we got a specific question from Lloyd about your relationship with OCP Group, and now that the environmental permit is forthcoming in due course, what planned conversations will you have as a result of that with OCP? Will there be any changes?
Well, we have, over the years and prior to me joining, there were conversations with OCP. We have been engaged with them. I have had conversations. Those are ongoing. I can't really comment any further than that on that. But obviously, the fact that we have our mining license and the environmental approval, will be forthcoming. I think we're now seen as we're real. We know what we're doing. We've demonstrated that. So you can have conversations over a long period of time, and if people aren't, completely clear that you're serious and you've got the capabilities, then they're just conversations. I think the conversations, will be different, are different. We're moving towards construction. We intend to finance the project and build it. And that will encourage various parties, not only OCP, to look at us and feel that there's a good value in having a discussion.
Okay, so we only got time for one more question. It's a classic question. It's basically about your dividend policy in due course, and what is your long-term approach to dividends once you are basically generating significant profits? Will you have a payout ratio of 25-30%, or is it too early to say?
I would say it's too early to say. I mean, the focus, my focus, and the focus of the team at the moment is solely on moving forwards, doing the engineering work we need to do so we're construction ready, and pulling the funding strategy together so that we have the funds to commence construction. I haven't thought, that's the key to me. That unlocks the value, the potential for the value. And we know that once we're in operations, we'll be generating a lot of cash, and obviously, the shareholders need a return on their investment. So, that will be the plan. But the team is completely focused on delivering what we need to deliver this year to get us into construction, early construction works at the end of this year.
Thank you very much indeed.
Graham, thank you for that. Very interesting. Some good points on ESG as well there. A good flavour of the scale of the market and the competition that there is out there. That was really insightful. Thank you very much indeed. I hope you've all found this afternoon's event helpful. We've had a really interesting collection of companies with really very different stories, very well told by the senior management of them. And so that concludes the presentations for the day. I'd like to thank all of our speakers for their contribution today, and you, the audience, for taking part in the forum, and thank you very much.